Hey guys, what's up? Zach is back with another video, and right now I want to go over a really good question that I get more than once, and it's when to buy LEAPS versus when to buy common. Now, common stock is just the underlying, just the normal shares. So, I think that really the answer to this question for me personally is going to be based on how much capital I want to put towards a position. How much do I want to allocate to this position? And how much risk do I want to take? Those are the two questions that you should be asking yourself when wondering this. So for example, if you want to go long on a stock and you don't know if you should buy shares, maybe the shares are going to end up costing $10,000. And you could possibly get the same exposure if you buy LEAPS for maybe half of the price, for $5,000. But it's going to be the same exposure. Of course, anything dealing with options is going to be more risky. But that is a given. But specifically, LEAPS are going to be pretty much one of the least risky things that you can do in options. So let's take a look at the delta on some of these LEAPS. So let's go into a popular stock. Let's just go ahead and say Apple. This is actually one that I was doing some announcements on. And as you can see, it actually bounced off our little buy zone and is heading up. This is easily going to be a $150, $180 stock. Anyways, so let's take a look at the options. And let's pull up our calculator so we can really dig into this. So if we want to buy, now remember the options, one contract is going to be for 100 shares. Keep that in mind. Let's go ahead and pull up the LEAPS real quick. And this is the vertical. We make sure we change this to single if you have level 3 or 4 options. All right, so here we go. And so this is LEAPS. Now, if you don't know what LEAPS are, this is the simple terms. This is any options that are more than 1 year expiration. All right, so here we are. We're out more than 1 year. This is 349 days till expiration, January 21st, 2022. That's a long ways out. Now let's check this out. So we could do a deep in the money. So in the money is, it's already past this strike price. Current price is $136. So let's say we do let's just say we do a $100 strike of Apple. This is going to be, pretty safe because first of all, it's deep in the money. After 1 year, if it's lower than $100, then we're going to lose out on our investment on how much this costs. Of course, we can sell it before it expires, but just to give you a basic idea. But it's $100, and obviously Apple is going up, and I don't see any reason why it wouldn't continue to go up. I mean, especially with the fundamental analysis that we've done. If you don't know, check out the website, prostockadvice.com, and you can check all of our due diligence, fundamental analysis, and market updates. But anyways, so $100. This is actually going to cost us around $4,200 for this LEAPS. These are expensive. But what I was talking about with the delta, check the delta, guys. The delta is in this column. The delta on this one is 82, more than 82. So what that delta means is this is how much exposure we're going to get to this position. So 82 just means 82 stocks. So if we do 82 stocks times current market price is about 136, let's just say. So that's $11,152. That's what it's going to normally cost us to get exposure if we just buy the stocks. So if we just straight up bought 82 shares of Apple stock and just held on to it, it's going to cost us around $11,000. Now, if you want to just do the safest thing that you can possibly do forever and just go to sleep every night and be comfortable and not stressful, just totally forget about this and walk away, wash your hands. Yeah, just buy the common stock. If you guys want to add just a little bit of risk and get into the leaps, more than 1 year expiration, then check this out. So we're going to be able to get 82 exposure for 82 shares for around $4,200. Usually it would cost us $11,000. So you can see we saved a decent amount of money. So 4,200 divided by 11,000. Yeah, it's a lot less capital that we're going to need to get the same exposure. This is a pro tip of Discord's going off. Guys, if you don't know, we just made a new Discord channel. The link in this is going to be in the description to join our Discord server. That is actually going to be my priority for answering questions and messages because it's getting pretty busy already. Thank you guys for supporting this channel. You're making me so busy, but that's okay. So anyways, yeah, the delta is 82. I mean, that's just going to give us exposure. So really you need to ask yourself how much capital you want to put towards these positions versus how much risk you want to take. Safest thing is just buy shares, obviously. And add a little bit more risk, but it's a lot less money. The risk here specifically is if it drops down, because we're deep in the money. If it doesn't hit our strike, which has already hit our strike, right? But there's possible in 1 year Apple could be less than $100. You know, do your own homework. You can decide if you agree with that or you don't agree with that. You know, personally, I think it's going to go up. But of course, bad things can happen. Now, another question that I had was, do we have to wait till expiration? No. Don't ever wait for expiration. I mean, you can, and you can get assigned and buy the shares, but there's no need to do that. You buy and sell these contracts daily, weekly, monthly, swing, day trade, whatever. So we can sell this before the expiration. Once it goes up 100%, we're going to sell. And I recommend selling at 25, 50, 100% profit, and then let one ride. So pretty much get 4 positions, 4 contracts total. Let's just say one we'd sell when it hits 25% profit, one we sell when it hits 50% profit, and then the third one we can do 75, 100. Just depends on what's going on. But we would evaluate it at the time we sold the second position, second contract, and then the fourth one or the last one we would let ride until closer to expiration, because once we've sold 3 in profit, 25, 50, and 100% profit, we've already gotten all our money back. We're guaranteed not to lose money. So of course, let the other one ride if you want, but that's totally up to you guys. That's just what I do personally. So anyways, that's pretty much it. It's pretty simple. There's not much to it. The deep in the money leaps, I mean, we can look at out of the money leaps, which is going to make us more money if it hits the strike. So let's take a look at it. $170. So the $170, the delta is only 34. So go back to our calculator. So if we get 34 shares for a normal price would be $136. That's $4,600. And here it's only going to cost us $920. So you can see that right there. So that's going to save, that's just going to save a lot of money. So really it's going to be depend, and that's going to be a better deal. Of course, if it's deep in the money, you know, it's already hit the strike, it's going to be more expensive than if it's out of the money. But again, you can do your homework because the break even on this at, say, for example, $170, if you're thinking like, well, do I think it's going to hit that? Well, I mean, just look at the break even is 30%. Do you think Apple's going to go up about 30% in a year? Well, let's check it out. See down here, we can actually switch, go ahead and go to chart settings. This is the easy axis, switch from linear to percentage. So we can see this is how much percent it's up. So start at this, for what's visible, it's going to be 0. So this is March. In March, let's go coronavirus. Okay, so that's right at the coronavirus, you see. Man, I really need to get in the habit of locking those things. Okay, so you can see coronavirus dip, boom, right here. Let's move that into what's visible so we just have a good idea. Okay, that's fine. So that's going to be 0%, and then up till right now is 130%. And that's since March. So what is this? February. So that's almost a year. Just play it safe and say 10 months. Okay, so let's get our calculator. So average, let's just confirm that. Yep, 130% over 10 months. That's easy math, 13% per month. So you can drag it out, you know. Or if you have this slope, you can drag out until that expiration date. So when was the expiration date on that contract? It was January, next January. So let's unlock this now. See, Webull is really good for this. So we're just going to drag that out at the same slope. Let's just assume, guys, it's not always going to be like that, but we assume it is just for research. And this is in 2021, end of the year. Okay. So if it, let's just say, if it continues at the same slope of growth, which it might not, but this is just for estimate. This is just how to decide which strike we're going to do, personally, for me. Sometimes, and also it depends on the fundamental. It depends on a lot of things. Any announcements, maybe Apple's going to come out with a new iPhone, right? Or who knows? Any type of mergers or different things like that. Or earnings announcements, sorry guys. But anyway, so we drag this out. Let's just get a basic idea, very basic. This is 2021. So it would put ups and like, yep. So let's go ahead and switch the chart settings back. I like to do this. So go to axis, go to linear, done, okie dokie. Let's move this down so we can view. So 2021, it's at the same slope. It's going to be $222. Okay, so let's just go back over to the options. So if we want to play risky, a little bit riskier, like, yeah, we could do $200, $220, but, you know, there's no need to do that. It's going to be a lot cheaper. And remember, it doesn't have to hit our strike. We can sell it. If Apple goes up one day, pretty much all of these are going to go up. Look, here's the change on Friday at market close. I mean, Apple was down, so all of these went down. I mean, that's just how it's going to go. So we don't have to, but we could get this. We could get even further out of the money just for cheaper positions because this is only going to cost $300. Of course, it's less. It's the delta is lower, 13. But it doesn't matter. You guys can think about it. But personally, if you want to go into long term, which is probably why you're asking this question in the first place, should I buy commons or should I buy leaps? It's not day trading. So you probably want to do long term anyways. So let's just say our slope of incline says around $222. All right. Well, we don't want to do $222 first of all. I think 180 could be pretty safe. It's going to cost us $732. So the break even is going to be $187.32 because the strike is 180. And you can see the break even is right here. It can just tell us. We don't even have to do simple math. And then also the break even percentage is 36%. But the break even is 187. So I mean, that's really what you need to focus on is the break even, because that's going to be your true what it needs to get to if you're making money or you're losing money. So I mean, look, I think 170 is not bad. 150, it's just a little bit safer, a little bit more expensive, but that gives you an idea. I wouldn't drag out the slope and then just get the option at 222, like drag the slope dragged out to the future expiration. I wouldn't do that because that's like pretty risky, you know. But of course, there's different strategies. It's just cheaper to do that. I mean, you can sell it, but really, just think about it, man. But if it's me, this is what I would do, and this is what I do. So I mean, we can look at a lot of stocks, but I think you guys get the basic point. Also, there's a graph right here on Webull, so it can show you for this contract at the 225. Why is it at 225? Did I click 225? Yes, I did. So let's go back to 170. I like it. 170 right here. Break even is going to be when it flips from red to green. And you can see how much money you're going to make if it goes to that price. I mean, this is just so convenient. So if it does hit our 222, which is where? Ding, 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 right around here, 222 you guys see on the screen. So we're actually going to make $4,300. And we can just simply see on Webull. It tells us how much we're going to make. And then also if it doesn't hit the strike, it's going to tell us how much we're going to lose. But the thing is, our maximum loss is limited. Max loss is only $930 because that's how much this contract would cost us. Anyways, guys, I mean, there's a lot to this stuff. If you have any questions, message me on Twitter. Follow me on Twitter. We do live trading on Twitter. I try to answer everything. Like I said before, the best place now to probably to talk to me and ask questions and stuff is in the Discord server that we have just made and is live right now. So I mean, go check that out, guys. It should be helpful, and there's some bots that post the live trades and YouTube videos and stuff like that, so you can get alerts. But follow me on Twitter, and we do the live trading right there for now. Message me if you have any questions, and remember, guys, I do one-on-one coaching. If you have a lot of questions, I would recommend doing that. You know, my price is not expensive. I'm really doing this pretty cheap for you guys. We're starting out. We're still a small community, but we're growing really fast, and really it's all up to you guys. So go ahead and make sure to enter your email address on my website so you are getting these notifications when new daily analysis is posted. So Guys, I'll see you on this other side. Peace.